Hello, you are watching Portfolio Watch. I'm Godfrey Motizwa. On the program today, we take a look at how share buybacks have shaped the performance of JSE listed companies. And in the second half of the show, we examine the shift in mobile data pricing and what this potentially means for earnings in the telecommunication sector. Now, fewer shares mean higher earnings for shareholders. However, share buybacks are in no way a guarantee that share prices in the long term will considerably gain value. Joining us now to unpack some successful share buybacks and the regulations through share buybacks or the JSE listed companies is Cobus Potgieter. He joins us via Skype. He's of course with AIP Capital Management. Cobus, thank you for your time. Let me find out at the beginning, are you for share buybacks or against them?
I'm definitely for them, Godfrey. They're certainly not attractive under all circumstances, but I guess as we'll delve a bit deeper into the different arguments for and against them, we'll find there's certainly a place for them from both a strategic investment from the corporate perspective as well as a tax perspective from the investor's point of view. They are reasonably attractive under the right circumstances.
Yeah, so let's begin with the academic exercise. When do we justify accepting a share buyback from a company?
If you've got a cash generative company that sitting with a lot of cash on the balance sheet, that creates a drag. It creates a growth drag, that creates a return on equity drag, because that's an asset sitting on the balance sheet, not doing much for you. If you can utilize that to buy your own book, because what the company is doing is essentially the same thing as you as a shareholder is doing. They're investing in those same assets. In fact, they're gearing towards them by lessening the cash drag and increasing exposure to the underlying operations. That can enhance value. Now, the important thing is you need to be buying value. The company needs to be trading at a reasonable valuation. And if you are using that cash to buy at an expensive valuation, similar to any investor on the JSE, buying an expensive stock versus buying a cheap stock, if it is cheap, you can create enormous value for underlying shareholders. In the first place, you're returning capital to them because naturally the sellers of these companies, of these shares, will obviously be existing shareholders. So should they want to exit, they could, And in the second place, by reducing the number of shares, assuming they're trading at a discount, once again, you're enhancing value for those that remain behind, because they can now get a bigger piece of the pie, so to speak, from a return on capital perspective, especially assuming that return on capital is higher than cash, which is all you would have been able to get from that interest anyway.
Yeah, but the other perspective, of course, is to suggest that because you have been able to build up that share, that cash base, if you like, wouldn't then the value be better spent by management in utilizing that cash rather than giving shareholders the cash through the buybacks?
Yes, so there's the can of worms for you. Okay, so we had quantitative easing through the financial crisis in 2007, 2008, and QE continued all the way in the US until 2012 and up until 2016 in the European Union. And what they thought with all of this easy money, and of course, corporates being able to tap cheap sources of capital, cheap sources of debt, we would see further investments in the economy. And what largely happened is corporates did tap this cheap source of money and then did share buybacks and propped up their share prices and delivered returns, excellent returns for their shareholders in different ways. The opposite of what everyone was hoping for, investing in their own economy, investing in their own operations, actually spending that money. If you're a retailer and rolling out new stores, if you're a miner and rolling out new mines, and sort of that's where it lies. So often what happens is if a corporate is run out of ideas, or business confidence is low, or as we're currently seeing, there's a whole lot of uncertainty in something like the resources sector, and you cash flush, are you going to now commit on a 30-year time horizon to putting up a new mining operation in a new country on these rights you own, or are you just going to return that capital to shareholders through buybacks and effectively leverage your balance sheet towards your existing projects, your existing book.
Yeah.
And that's sort of the trade-off. So sometimes it can be an indication of business confidence. Obviously, if you think, I'm posting an ROE of 16%, and this project would give my investors a return on equity of 25%. Ideally, you would be allocating the capital there. If you can't mimic the 16% you're getting on your current projects or your current operations, why not just gear towards those, because the cost of cash is around 8%.
Sure.
So then it makes sense to buy your own book and enhance shareholder value that way. So there's a mix. I mean, management competence needs to be applied towards both what's best for investors in the long term, in terms of long-term capital spend and capex specifically, which is what we were not getting from QE. We were hoping for more capex. We weren't getting that capex. We were getting share buybacks. Or is it genuinely in investor interest? Should you be sitting on your hands because those projects are not available? And that's why in any decent management team, you need both people who are strong operationally and people who are strong from a financial engineering perspective to understand where the money is better spent.
Absolutely. But indulge me a little bit here, Cobus. What about when you look at the impact on the shareholders? Which shareholder benefits the most here? Is it the one that sells to you as you are buying back those shares, or is it the one that holds on to the valued shares after your buyback?
Look, if you're buying an overvalued share, I would venture out there and say Clicks was a very aggressive purchaser of their own shares, and at stages they were purchasing their own shares on PE multiples of 33, 34, 35. Then by all means, I would say the seller is the one benefiting the most, because the balance sheet's now being used to prop up the share price, and I'm allowed to exit, and the guy who remains behind now has additional exposure to an even more expensive share.
Sure.
So in that instance, no, the guy who remains behind gets prejudiced. Conversely, if you're buying a cheap company, if you're a Raynit, which I know you wanted to chat about, where I can objectively track the discount to NAV as at spot. Let me have a squiz at my model here, being around 40%. That is incredible upside. Being able to buy those assets that you already own at a 40% discount to reality, to what the market is telling us through objective listed inputs in other jurisdictions. That enhances shareholding massively. So yes, the guy selling to you still gets his liquidity, and if he wanted to sell, that's good for him. But at the same time, it enhances value for the remaining shareholder, because now he's picking up those assets at 60% of the value. And who doesn't want 1 rand for 60 cents? It sounds like a great deal to me.
Sure. So here's a double-edged question. Now, what is the message that you as management are sending to the market by engaging in a share buyback?
That business confidence is low, that I'm not willing to invest in the jurisdictions I'm operating in.
I'm not able.
I'm South 32, and I don't know what the value is of my prospecting rights. I don't know what the labor unrest situation is going to be for the next 30 years, and I'm simply not willing to make that capex commitment. Alternatively, I'm sending the message that my share price is cheap, and I believe that I can enhance shareholder value more by buying at that reduced discount. So it is a double-edged sword. You're absolutely right. So if a reasonably valued company is doing share buybacks in lieu of doing capex, I think that's a sign that we're not confident in either the sector we're operating in, the jurisdictions we're operating in, or the industry as a whole. In this case, the mining and metal sector. Or otherwise, you could say that, listen, the share is so cheap. This is good value, and I mean, for Clicks to be buying back shares at that kind of multiple, considering that they claim a return on equity of over 40% for the new stores they open, that doesn't quite add up to the same extent. And I would argue, you're doing a bit of creative financial engineering with your balance sheet, propping up the share price a little bit, and not really employing that capital efficiently, but in the short term, management was incentivized by share price. So there's an issue there. There's a serious principal agent issue there, where management who might be incentivized in the short term end up buying shares to pull up share prices, whereas long-term investment would have been more value accretive to the underlying investors. So this situation does need to be managed. But as you've alluded to, the confidence in the industry and the confidence in the business itself, particularly in terms of growth and expansion, is directly correlated to people's willingness or unwillingness to do share buybacks.
Quickly, Cobus, do we have cases of screaming share buybacks in the market, and do we have a couple of examples of disasters as well?
Well, I think we've basically mentioned both already. We've seen Reignitt, being a no-brainer, an absolute no-brainer. We've got an objective discount, incredibly attractive, and we've got a Clicks, which is doing it at a level where I would argue it's in fact destroying value. On occasion, sometimes the share price does get cheaper, and they seem to buy throughout the cycle. There's not any real pattern to discern from that. Whereas on the Reignitt side, because it is so cheap, you do pick up that they're actually looking for the lows. They're probably running discount models of their own and looking for particular levels where they know they're enhancing and maximizing value for underlying shareholders.
Glencore
on the current valuation, I'd actually say it's very good. Again, like we said, shorter term incentive, and the share price has come off a lot from the earlier resources rally we saw globally in the first few months of the year. And at the current valuation, it's actually incredibly cheap, and I can't blame management for trying to return capital in this way. One thing we need to consider is, for you or I, this is an incredibly attractive action by management, because the alternative for them, if they don't want to invest in their own dividends, in their own businesses, is of course to declare dividends. Dividends are not tax efficient for you and me. They're not. We prefer capital appreciation with the underlying assets, and because we're going to pay dividend taxes. And from that perspective, this is very nice. I'd rather just sell a more expensive asset than pay the dividend tax away, which they've sort of forced on me, and it creates that optionality where I can sell from this, or I can remain if I wanted to, from this elevated valuation caused by the share buybacks, versus the dividends, which is final. All shareholders get cash, and those that are not in particularly tax efficient situations, such as retail individuals, are going to pay their dividend taxes away.
Cobus Potgieter, thank you. He is director at AIP Capital Management. Now, coming up after the break, we discuss how to wire in profits with telecommunication stocks. Do stay with us, and please do consider what stocks to keep in your portfolio. Now, Vodacom and MTN Group, South Africa's biggest telecommunications companies, have rushed to their defenses following the Competition Commission's ruling, which found that they are overcharging, in particular, poor customers over data. Now, telecom stocks have come under pressure as numerous scandals have also tainted their reputations. Joining me to discuss which mobile stocks to keep in your portfolio, as well as the merits of these accusations, is Thecla Mbongue. She's Senior Research Analyst at Ovum. Thecla, thank you for your time. So I wanted us to begin by looking at the fairness of this accusation that these telecommunications companies appear to be favoring their richer customers against their poorer customers. Is it a fair accusation?
I wouldn't say it's a fair accusation. It's not fair, actually, because when a company charges X amount of money to render the service, and in this particular case, we're talking about rendering data services, we have to take into account how much themselves they need in order to, or how much they're spending in order for them to deliver the service. So there is pricing, but behind pricing, there's a lot to take into account. Pricing data services is a bit higher in Africa, not in terms of the value, but in comparison to what the ordinary end user earns. Actually, it's quite a big share. and not only data service, but telecom service of their income. But we have to take into account that producing or delivering the data also has some cost for the operator.
Absolutely. You know, Thecla, one of the things that has really confused me is, like the other day I was listening to an expert trying to explain the data pricing of these companies, and I got very confused. It's a very complicated business. Does it have to be as complicated as that, or are these companies making it complicated because in it then it enables them to charge how they charge?
No, they don't. Well, probably they can make it a bit complicated, but we can't say that they do just make it complicated on purpose. If we just take the example of you and I having a Gmail address, we have to take into account that in order to connect to the Gmail address, we have to connect to a Google server. Until very recently, Google didn't have any point of connectivity here in South Africa. So we have to connect all the way to where they are. That was maybe in the US or somewhere else. And when that connection leaves South Africa, the operator is going now to pay some additional cost in order to use that international route, if I can say.
You have looked at these stocks, and I'm hoping that you've been able to compare to how they price their products here in South Africa to other African countries and internationally as well. How do they fare?
Well, compared to other countries in Africa, it's the same story. Everyone is always complaining that data is too expensive.
But is data in South Africa more expensive than in South Africa? That's the direct question I wanted to ask.
Data in other African countries?
Yes.
No, it depends on the markets. We have 54 markets across the countries, across the continent. So it depends on the market. There are some countries which are less expensive. If I just take into account, for instance, Nigeria and West Africa as well, Kenya as well. But if we look at East Africa, there's been a lot done by the authorities themselves in terms of regulation in order to ease the operating environment and also regulatory pressure, taxation as well, that we have to take into account in those markets. So it's each country has their own challenges and environments.
Let's talk about, of course, some of the challenges that these companies are dealing with. Regulation is one part of it. There's also, of course, the high cost of components that they require, the technology in order to run these businesses. When you look at them as a whole and where they are priced now by the markets, how do I put it? Can I say that they are being fairly priced at the moment by the markets, or do you think in terms of potential we could be going here higher than where we are?
Oh, not higher, probably lower.
Right.
Yes, there is a potential to go lower, but obviously we are talking about companies who need to make profits, for instance. So that will be, for instance, sometimes you have some countries where the regulator will impose or cap the pricing, saying that it cannot be as more expensive that, or you also can have the reverse where the regulator will say, no, you cannot go below that pricing, because sometimes competition will lead some operators to reduce their price drastically.
But when you look at the stocks themselves and how they have performed, I mean, I want us to look back on the results that we've seen coming through from them, and also take into account how the markets have reacted and try to understand whether these are good companies to invest in from now here, because the suggestion is that they're going to come under pressure from regulators to bring down prices.
They're going to come under pressure to bring down prices, but the regulator as well is reasonable. They have to take into account a lot of things. For instance, in terms of when we're talking about data services, we are moving from a voice-centric market to a data-centric market, and sometimes bringing down the prices is not sustainable. I just take the example of WhatsApp. Remember that a few years ago, some of the operators, namely MTN, had a price plan whereby it was free WhatsApp, for instance, which is not sustainable. You see, just you and I, the way we're using WhatsApp now and maybe 5 years ago, we do everything via WhatsApp. So it has to be sustainable. And even the regulator knows about the market conditions as well. So there would be pressure to bring the prices down. But you see that the fact that the regulator themselves, if we just take the example of South Africa, doesn't cap or doesn't put, they voice, they sometimes raise concerns, organize suggestion or organize even some consultations. But in terms of really applying pressure, okay, puts that price to X or Y amount, this is something that they will do with caution.
So years ago, voice was everything for these telecommunications companies in terms of their revenues. And then we moved on to data, and data became the next big thing. When you look into the future, I'm hoping you can look into your looking glass and tell us what you see. Where is the growth going to come from these companies? What are they focusing on?
They're still focusing on data. We are just data is everything. We're just at the very start or the very beginning of what data can do.
Oh, really?
Yes. When we look at these companies, for an investor to buy stock, they have really to have a level of trust in that company, and that comes with the roadmap and what the company strategizes for the future.
Yeah.
Now we hear a lot of the companies talking about broadband access everywhere, and also 5G, the fifth technology, the fifth generation of telecommunication as well coming, and that will enable further data usage. When I talk about data usage, not only talking about you and I just using our phone to do WhatsApp voice calls or WhatsApp video calls, but we can talk about the segments such as in the industry using what we call Internet of Things, automation, e-health, for instance, e-education as well. I mean, using, providing services remotely.
Sure. What kind of potential competition can come into those segments that you are now talking about, that comes with the Internet of Things and obviously the growth, should I put it this way, of the fourth industrial revolution?
Well, sorry, what kind of competition or service?
Yes, potentially do you see coming into play with them? Because we have seen these companies that provide Wi-Fi services in the home, the broadband companies, etc., etc. Could there be potential here for a collapsing, if you like, of the telecommunications companies to include these broadband services?
They do. That's what they do. We have a lot of convergence coming. So basically,
is that what you call it? It's convergence.
Exactly.
Okay.
We see them being like a pipe, whereby all these services and other sectors are coming to pigtail on the network to provide services, or to provide services in a better way, in a faster way. Yes.
But what do they do? Do they do they buy up these broadband service providers, or does it happen the other way around? Who will survive here? Because that's what I'm trying to understand. Because I'm thinking at the moment, when you look on the stock market, obviously the mobile phone companies are huge companies. I mean, you look at Vodacom, you look at MTN. These are huge companies in terms of revenues as well as market capitalization. And yet the broadband companies appear to be smaller. So I am trying to think in the future, who's going to be who?
Well, our first mistake now is to call them mobile phone companies. We shouldn't call them like that anymore. They also provide broadband. You hear that? Yes, Vodacom provide, or even MTN provide broadband over 4G, which is a mobile technology, but also over fiber, like the likes of Telcom, or for instance, Vumatel. So there is a lot of convergence whereby even the likes of MTN and Vodacom can now be called broadband companies as well. The smaller companies, what they've tried to do, they didn't, most of them bother to go too much into the mass market, which was already served, as you say, by these huge companies, which are deployed everywhere, and against which it's difficult to compete. But what they try to serve is the enterprise and higher end segment as well, and also to partner with Vodacom, MTN, and Telcom to resell, rather than just spending their money and spending their money deploying technologies on the ground. That's going to be costly and also time consuming.
So there's a huge opportunity for consolidation here within the sector on its own. What about this move into content creation? Because we have seen it in the US, and some people are suggesting that we could see this coming very quickly here. We haven't seen it yet. When is it coming?
Well, depending on what you call content creation, these are just simple applications actually that people are
but I see them also, you know, getting into our space as journalists, and we get very jealous because now they want to, you know, someone was saying Facebook is actually a publisher and has destroyed the traditional journalism industry like nothing else in the past few years.
And it's true that everyone can even become a journalist nowadays. I can just now, record my videos and then post them online. And then start, when not everyone can become a journalist, but actually do their own reporting. So in terms of content creation, local content is also going to be key. We're going into more and more segmentation, whereby the consumer is really interested, or has access to what's happening next to him. Obviously international news or international content, but it is very important for them to get access to local content, for instance. And we've seen a lot of partnership from Well, when we take, for instance, the example of Please Call Me, like Vodacom, and the Please Call Me case, it was a matter of a local entrepreneur bringing an idea to the operator. And that's a lot of what they do. For instance, when you hear about they're launching XYZ product, they have a lot of entrepreneurs who come to them and provide them ideas.
So there's a lot of opportunity for everybody there. Let's leave it there for today. Thanks for coming in, Thecla.
You're welcome.
That's Thecla Mbongue. She is a senior analyst at Ovum. Now remember to email your questions to portfoliowatch@abn360.com and your tweets to #PortfolioWatch. Also, don't forget to join us again next Tuesday at 1900 hours Central African Time.